Let's turn to the financials. One of today's best groups after a rough period that has seen that sector underperform the broader market. Our next guest, a longtime follower of the group. He's out with an ominous warning about the sector and the market in general. Chris Whalen is the chairman of Whalen Global Advisors. He's here with us on set. So is Wells Fargo banking analyst Mike Mayo, who disagrees with what Mr. Whalen's about to say. So they tell me. So I'll start with you, Chris. The headline for you that got me to say, let's get this guy in here, is you think that we have this looming credit crisis.
Well, it's a slow ebbing credit crisis. A year ago, I predicted that net interest income for the banks was going to flatten out and go negative. And it did in the first quarter. Small, but it's been going up for 8 years. That was the gift that Ben Bernanke gave us with quantitative easing. Lots of deposits, lots of margin for the banks. But now the flip side of that is the Fed reduces the balance sheet, which is tightening, let's remember, is that you're seeing liquidity increasingly scarce, even though all of us would say, my God, look at all the cash around for different strategies and different sort of investment.
So I thought you were calling for a credit crisis this summer.
Oh, no, I am. I think we have a repeated December staring us in the face. Why? High yield spreads are going up. We have a dearth of credit in the non-bank sector particularly. I think of the unicorns like Tesla that are assumed to have market access to fund their operating losses. And then finally, the mortgage space, where I spend most of my time, they're not making money. You know, we're hoping to get a bump from refis as rates fall. The 10-year, I think, is going to go through 2, by the way. But the lack of profitability in that sector goes back to what the Fed did to the credit markets 5, 6 years ago. So to me, all you need is one externality, one little bump, and I think you could see credit run away from all of these non-bank finance companies, mortgage lenders, et cetera, because investors don't have a big tolerance for risk right now.
Mayo?
First, I love Chris's views because I love the healthy paranoia. And as long as everybody's still paranoid about what can go wrong, it reduces the chance we're going to repeat those mistakes. I hope we have a repeat of December because that was such a fantastic buying opportunity.
I agree with
like
you.
we have right now. And by the way, so the theme here is 1995. 1995, you had Forrest Gump won the Academy Award. The 49ers won the Super Bowl. You had Paisley prints that were in fashion. And it was the best performance by bank stocks in modern history. From 95 to 97, bank stocks tripled, the market doubled, the best relative performance in decades. And you know what? The analogies are in place for 1995. You have the end of a Fed tightening cycle. I don't know if the Fed cuts or not, but it's the end of a Fed tightening cycle. You have, real significant efficiency improvement in the space. We think the banks hit record efficiency in a few years. You have a degree of, if not deregulation, more regulatory streamlining. You have a reduction in deposit insurance costs. Oh, and the one difference, instead of waking up every Monday wondering if a bank's going to spend too much in another bank, banks are returning historic amounts of capital. You have the Fed stress test, what's called the CCAR. Later this month, we look for a 15% increase in cap return. Everything's lining up. Oh, one other difference versus 1995. The best value investor of all time, Warren Buffett, has his biggest overweight in banks in history. So that's not what we recommend the banks, but it's all lining up together.
But today is not 1995. 1995 is the center line, by the way, for banks for the last 50 years. Boring year, great year. But now you have credit metrics that are so messed up. I mean, think about this. Every metric that you look at for bank-owned properties in the real estate sector is got negative credit. In other words, you can't lose money on a loan. Why? Because they goosed home prices. Will they stay there? We don't know. But what you do know is that the markets are signaling to you that credit has no cost. When was the last time this was? 2005. It was 2 or 3 big banks, WAMU, Countrywide at the time. Now it's the whole industry. So the Fed has doubled down on asset price manipulation, on messing around with basic credit metrics that we all use to do our work, and we don't know where we are. So for a lot of investors, it's almost better to get out than to try and figure this out, because we could say there's a dearth of liquidity on the one hand, and then you look at another sector and there's more cash than they know what to do with.
Well, I'd say there's absolutely, causes for concern with credit. There's always causes for concern, but you better not start at the banks. All right, you look at the non-bank financial lenders, and we can come down with the list, whether it's, private equity or BDC firms or these, CLOs or a host of other non-bank lenders that are getting in there, bidding all kinds of crazy, providing financing at rates that they probably should not be offering it for. But the banks themselves have structurally lower risk, and that's what's underappreciated.
You guys agree with each other.
Not on the banks. The banks are fine here. The banks and stronger for longer credit losses. So in other words,
they have low losses, but they're not making any money. The problem with what the Fed has done is that funding is expensive right now. Funding is off the front of the curve, right? 10-year is falling. So there's no pricing for banks to get a little bit more on loans, a little bit more on leases, a little bit more on their securities investments. Right now, non-banks like REITs, anybody who uses leverage, is looking at an inverted curve. What does that tell you? That carry has no value anymore. They're all running out of that sector, and some of them want to buy banks. But right now, a resi REIT or an agency REIT like an Annaly, for example, you don't want to be there. Because if the curve remains the way it is, if the Fed sticks to their guns and doesn't do anything really to change policy till September, when I think they're going to stop the runoff of the balance sheet, then these guys are in trouble. Last point, every dollar that runs off the Fed's balance sheet is a dollar of bank deposits that's disappeared. Deposit growth is at the lowest point in 7 years. And by the way, the economy can't grow. You can't make more loans unless you have deposit growth. That's where it comes from. Bankers start with, how much money do I have this month to lend? And that's how they figure out what they're going to do. Right now, the growth isn't there.
Well, yeah. I'll agree with the point that, look, net interest margins, the best improvement has come and gone. I get it. But 1995, the net interest margins got worse and efficiency still improved. So as long as revenues grow faster than expenses, great things happen with earnings. So we still look for about double-digit EPS growth, even without a whole lot of top-line growth. And if you want a lot of top-line growth, the banks, get in a time machine, go back to 2006, and see how that turned out. That didn't turn out so well.
We've been surviving on that efficiency trade for 7 years.
Yeah, but there's still a lot that they can do. Efficiency.
They can fire all their people, sure.
They certainly will, unfortunately. But wait, Mike, I guess I get to what Mike was just getting at. So fine, they may have pressure on NIM and net interest income. I get all that. Why does that have to be a calamity of credit? There's a difference, though.
That'll come later. Credit's
right, so,
2 years from now.
Okay, so you were just saying, though, that you were concerned about the credit cycle this summer.
No, I'm worried about counterparty credit companies failing. Loans, mortgages, no. We have no credit issues there. So I'm worried about the guys that the banks can cut off with a phone call.
Okay, I understand that,
but
that doesn't necessarily mean that
warehouse lines. Remember, in December, the big banks didn't show up. They all pulled back. That's why we had a crisis. So all you need is the banks to decide that they don't like the risk on their non-bank warehouse clients, and they're done. They're out of business.
These companies have not, the banks have not had superior revenue top-line growth for years. For years, right? And it has been an efficiency ratio story,
That's how they've hit the EPS targets.
An efficiency ratio story plus strong capital.
Plus excessive capital.
Right, plus CCAR, so plus valuations. I think that you can make money. And I was saying before, it's kind of like a tactical thing, but it's not a calamity like what you're saying, at least not in near term.
You have one unexpected non-bank default this summer, and we're going to have a very different conversation.
You mentioned Tesla. Like, you think it's going to be a high profile, or you're saying it's a slight uptick in the constituents of the HYG?
Well, that's a very good question.
Is it a retailer? Like, what blows up?
If it just happens without any warning, in other words, I think they've been losing credibility. That's why the stock is down. Stocks go up for hope. They go down because of credit.
Are you saying that that's systemic for the United States financial system?
No,
I know it's big, but it's not that big.
It would be a surprise. It'll be another non-bank name we're not thinking of.
Okay. So let me ask you this, Mike, and Chris, weigh in. Isn't it ironic when you say the banks didn't show up in December? Isn't it ironic that the way the new regulations were written, it's to prevent them from showing up?
Oh, absolutely.
So we don't want them taking prop risk anymore? So who do you want to do that? Private equity?
But the liquidity rules have set us up for a problem. The bank, the regulators said, they need more capital. They have to be islands. They're not allowed to trade repo with one another anymore. We have no unsecured lending between banks anymore.
So now be careful what you wish for.
That's right. So in December, they were all told that they had to show how much liquidity they have, which means they have to cut off their customers. Great. And they were piling in the door with the firm I work with good collateral. These were
Mike, what do you think about that notion?
Well, look, there's absolutely crazies on the street. We're just saying it's not the large banks anymore. You have this great oversight. And what I would say to any bear on the banks, you saw them show up in spades in December, where do you think bank losses are going to go? Right now, bank losses, total loans, are 50 basis points. The long-term average is 80 basis points. And the financial crisis, it was 300. So a lot of people investing today weren't even around for a recession other than the Great Recession.
In December, I backed up the truck. I bought U.S. Bank. I was buying preferreds because they all sold off.
So where's the excess? Fintech?
But they're not cheap today.
Is it Silicon Valley backed fintech companies that are making non-traditional loans based on Facebook likes? Is it private equity that are getting into lending direct? Like where is, if I'm an investor and I look at my portfolio, where are the holes? What should I be worried about? What should I be thinking twice about?
But the banks have the risk, but it's exactly where you just said.
Okay.
It's in their customers. You know, this is why all the regulators fret about non-bank risk.
So as long as the economy stays reasonably strong, maybe strong is the wrong word, reasonably well, okay? Interest rates don't go up. Companies can service their debt. You don't have a high-profile bankruptcy like the one you're talking about. Your scenario doesn't play out the way you fear it will.
No, I just worry that the Fed is mostly focused on their models. They went all through the fourth quarter last year ignoring the fact that high-yield spreads had blown out. They were over 500 basis points before the end of the year. Were they paying attention to this? I don't think so.
So this goes to the conversation that we were having with Leisman, whether they made a policy mistake in December at minimum. There are others who say
they almost ran the ship aground. We came real. Look, issuance went to zero in corporates. It went to zero in most ABS categories. You know, mortgages have been down for 4 months. What's going on?
So what happens if they cut rates between now and?
I think they're going to have to, but it's more important to stop the runoff of the portfolio. As much as I hate it, as much as I disagree with what Ben Bernanke did by hyperinflating the Fed's balance sheet, you can't take it back. Because every dollar is a bank deposit. You got to think of it that way. The whole deposit base is slowly shrinking.
Well, maybe Powell realized that, and that's why he changed the autopilot.
Of everybody on the FOMC, I'll put my money on Jay Powell because I think he at least understands these dynamics. I'm not sure about the rest of the committee.
Well, no, look, what I'd say, in a low interest rate environment, people pay their bills, credit losses stay lower for longer.
Yes.
Chris might be right about some non-bank financials having issues at some point, but as far as the large banks, we come back here 1 year from now, and you'll see bank credit losses still below the long-term average. And I'll give you 4-to-1 odds. What are we allowed to bet? Can we bet like a coffee?
No,
I'll buy you. Okay, I'll bet Chris dinner. Okay.
My pleasure. Look, two things to watch.
I want to
high yield
dinner.
spreads.
I just want to.
Oh yeah, you come.
Okay,
high yield spreads and real estate prices, because if you start to see real softness in commercial real estate, residential real estate, that takes you back to higher loss rates.
Didn't we see that in January though, and it was a head fake?
I want to get to a break. Go ahead.
Didn't we see home prices drop suddenly, shock everyone, and then come back to spring?
The high-end markets have been softening for a while. New York's been softening for 2 years.
Let me just say, in our earnings models, we have loan losses almost doubling over 4 years for the largest few banks, and we still have EPS growth to 10% per year. So higher loan losses is not a surprise, and we think they're just on a steady glide path back to normal, not some sort of calamity.
It's the surprises that matter, Mike.
Always.
Well, they always are. Guys, thanks.
Thank you.
Chris Whalen, Mike Mayo. Great conversation. Really appreciate your time today.
Guys.